Guys, this market is like a roller coaster, jumping around every time there is a new report, a rumor, or some Fed statement that may change investors' hopes about when the Fed will stop raising interest rates. The collective wisdom on Wall Street is that signs of a recession is good because it means the Fed will stop raising rates and start to lower rates, so the stock market bubble can go back to inflating. Now, signs of a stronger economy are bad because it means inflation is not yet tamed and the Fed has to raise rates higher and for longer. So, where are we today? Well, today, after a stronger ISM Services report, we are back at the belief that the Fed will have to raise rates more and the terminal Fed rate will be higher than the market believed just a few days ago. Let's take a look. Now, in this Wall Street Journal article, they say the Fed to weigh higher interest rates next year while slowing rises this month. And they say brisk wage growth may lead officials to consider raising policy rate above 5% in 2023 while approving a half a point increase in December. Now, the Fed has a blackout period that started over the weekend, so they can't talk before the next meeting. So they use this guy in the Wall Street Journal, Nick Timiraos, which they have nicknamed Nicky Leaks, because anytime the Fed wants to leak something to the stock market, they give it to him, and then he puts it out there as kind of a rumor or an unsubstantiated leak. So apparently they floated out this to him today or yesterday, saying that wage pressures could lead them to continue lifting to higher levels than investors currently expect. But just last week, they were thinking the opposite, right? And the thing that caused that change in stance is the services PMI that came out today, and it supposedly rose from 54 to 56.5 in November, which indicates a hotter economy than the Fed would like, because that means that they still have to worry about inflation. So here is the services PMI in the blue line. It's up, but the U.S. services PMI business activity is actually down below 50, meaning a contracting economy. And so this is kind of a tale of two cities. You have the ISM manufacturing below 50, indicating a contracting economy, but the services PMI now are above where they were last month, and they're above 50, indicating a stronger economy. But if you look at the components of the services PMI report, you see that the new export orders jumped down from above 60 to 38.4, which is on par with where they were when we shut down the economy for COVID, here in the red line. And so here's the components of the ISM Services survey, and 6 of these components are actually down from October to November, with new export orders being down 9.3 percentage points. And the chief business economist at S&P Global Market Intelligence said, the survey data are providing a timely signal that the health of the U.S. economy is deteriorating at a marked rate, with malaise spreading across the economy to encompass both manufacturing and services in November. So their survey is saying that the economy is contracting in the fourth quarter at an annualized rate of approximately 1%, with the decline gathering momentum as we head towards the end of the year. So here's their chart. The gray is GDP, quarter per quarter percent annualized, and the green is the composite output index. It's the growth since the previous month, and you see that green line is now negative. So the stock and bond market fell after. So the Wall Street Journal Fed whisperer now confirms higher for longer rates, and saying that higher inflation in labor-intensive service sectors of the economy could lead more of them to support raising their benchmark rate next year above the 5% currently anticipated by investors. So just a few days ago, they were thinking, oh, it's going to be under 5%. Now we're back to, it's going to have to be above 5%. And here's a chart of US Financial Conditions Index. It's inverted. So higher is down here, lower is up here. Financial conditions have been easing since October. And looking at the Fed funds rate versus US Financial Condition Index with the index higher up here, you see as they are raising rates, the Financial Conditions Index is actually now coming down. So they say if one of the huge questions for next year is calibrating the long and variable lag effects of the hikes that have already come to pass, this would suggest the Fed needs to keep the pressure on. And so you see the roller coaster just since November 30th, with Powell hinting that they can lower the terminal rate and maybe not raise rates by 3/4 of a point, but only half a point. So that made the terminal Fed rate expectation, meaning the high point of where they have to raise rates to before they'll stop and consider lowering rates, went from above 5% all the way down to 4.9, and then over here to 4.8 when the payrolls news came out, and now it's back up here to 4.95. The terminal rate and subsequent rate cut expectations are back around 0.45 when they were about 0.36 up here. And I'm sure if you wait a few days, some other bit of news or rumor or Fed speak is going to come out, and these are going to jump some more. And so with that news, of course, the S&P 500, the Dow, the NASDAQ, and the Russell futures all started heading lower. And the most shorted index, which had a big run at the end of November, is now pulling back and didn't even bounce on that news today. And the S&P 500 is now below the 200-day moving average. So everybody was celebrating when it went above the 200-day moving average, but it didn't last too long, and right now we are back below it. And so the dollar was up on that news, expecting higher interest rates, and the yield curve between the 2-year and the 10-year got even more inverted. We haven't seen this level of inversion, minus 0.81%, going back all the way to 1981. And because history doesn't repeat, but it rhymes, here is an overlay of the S&P 500 in red in 2008 to 2009, and us right now. And here we are now. So if we follow the path of how 2008, 2009 played out, we might be in for some of this kind of drop. Like a drop, a bounce to the 200-day moving average, and then down again. So that's where we are right now until the next unexpected report, rumor, or Fed comment. It still feels to me that we are in the bargaining stage of stock market grief. The market is looking for any little nugget of info that will give them hope that we go back to the stock market highs. I don't think that is happening anytime soon, but there will be more of this manic up and down, raise rates, don't raise rates, euphoria, and then gloom until it just tires out the retail buyers and chips away at their brokerage balances. Try not to follow this too closely and get caught up in the up and down roller coaster. Your brokerage account will thank you for it.